Yeah, we're going to be talking about breaking down policies. And so I'm really excited about that because when you guys are going out in the field, you got to be passionate about these things and number one, understand these things. And so I think it's going to be great today because we're going to have a mixture of a lot of the technical side of like using the presentation and then also breaking down the policies with stories and what to point out. Sheila's gonna do an amazing job going through all of that about specific policies. So I'm gonna be going through a lot of the parts of the presentation, the things you need to click, where to go, what to explain, things like that. So I think it'll be great for you guys. So take a lot of notes and let's get going. So we start off here. Everything always starts with mindset, guys. So you wanna make sure that you just the right mindset going into things. And so right now, you got to have urgency. And I know when she was going to go through her story, she may mention some of this, but you have to have urgency when setting appointments because you never know who you're going to help and whose lives you're going to change just by providing this information. And it's not only about the bonus or only field training. You were literally saving people's lives. So you have to have urgency. Anybody that you know, reach out to them at all times, get an appointment done. If something reschedules, figure out quickly when you can get them rescheduled and just meet with people, guys, meet with people. So no one else reads their policy. Nobody reads their policy. In my presentation, I literally ask everybody, hey, how often do people read all 50 pages of their contract? Everybody says nobody, not me. I don't even read the first page. Nobody reads it, guys. So when we talk to families and they have policies, or anybody you know, friends, coworkers, anybody, you can just say, hey, we're going to ensure one of two things. Either number one, everything that you have is great and good to go, or number two, you may want to look into some things or change some things. And so it's extremely important. I've gone into appointments where sometimes people are super arms crossed, don't know what to do. They're like, they're going to try to sell me something. And we start going into it and we start talking about, they don't want to tell us how much coverage they have, any of that. And then you start breaking down whole life, universal life, and they get used, like see their eyes and they're like, oh gosh, oh my gosh, I thought it was okay. And then they're like, I got to grab my policy. And then they get it. And they start sending you pictures and things like that. So it's great when you learn how to understand this. And people do need us. Just offer the free analysis all the time. I'm pretty sure, I was talking to Sheila yesterday, that's one of the biggest ways that she helps people. She's like, hey, just send me your policy. I'll look over it for you. I'll do a free analysis. That's what we offer here. So just offer it and offer it as many times as you can to people. Anybody that you know has a family, even if they don't, a lot of young people, parents have policies on them as well. So just offer a free analysis. That's how Mike and I got one of our clients this week. He has a coworker and had a policy, and Mike was just like, oh, do you know what type it is? And like, I think it might be cash value. He's like, oh, we got to meet. I want to look over that with you. Right. So just always offer an analysis. Become an assassin. And so we always want all of our agents, our teammates, everybody in our hierarchy, Shaq has said this, to become a life insurance assassin. You want to be able to see a policy, break it down, know what you need to be looking for so you can kill it. Because if somebody does not have Primerica term, they probably don't have the best insurance. So with that, you want to become an assassin at killing all of the mistakes that people can have, whether it's the mistake of relying on group insurance, whether it's the mistake of relying on cash value or what we call trash value. Maybe they have a term, but it's a terrible term. We'll show some examples about that today. Or obviously if they have no coverage or not enough. So we always want to make sure that we know every single scenario that someone can be in and how we can help. And then field training. I know I mentioned that earlier, but field training to duplicate, not field training to go out in the field and write all the sales, but field training to duplicate. Anytime you break down a policy with someone on an appointment, are you going over that with your trainee? Are you going over that with your teammate? Are you explaining to them why we were looking for those certain things? Did they write down all of the things you wrote down? all of that. So we're field training and we're recruiting people so we can go out and duplicate and have other people be able to go out and help. Because obviously we can't be in more than one place at one time. So guys, it's extremely important to know these things, but then not just know them, but transfer that information to other people. So we're gonna get right into it. I'm gonna go through the cash flow, I mean, not the cash, see, recruiting's on my mind, not the cash flow quadrant, but the insurance quadrant. So when you look at it, when you guys get to the part of the presentation where it has the financial house and it has the 4 levels, the foundation, we always want to kind of make sure that we're going to go through that foundation part. And so once you click that, that will basically provide this slide here. So when the slide comes up, it's going to ask how much coverage do you currently have. And so at this point, I usually ask how much coverage for the husband and the wife. Do they have anything on the kids? And then once I figure out how much coverage they have, if anything, then I usually say, well, these are usually the 4 scenarios that people are in regarding their income protection. And so when you look at that, since you have coverage in place, then obviously number 1 doesn't apply to you, but there's 3 scenarios that could apply. Either you have it through your job, or you have private insurance, which could either be cash value or term. So Mr. and Mrs. Client, do you know which type you might have? And sometimes people say group, sometimes people say they have their private. So you want to ask good questions to kind of figure out where people are at. And then that's usually how I kind of gauge the situation. Now, if somebody has group insurance, I will definitely go into group and kill it. So today we're not going through group. That could be a whole training in itself. You always want to kill group. People should have no questions about why you should not rely on your group insurance and why it's extremely risky when you go through that. There shouldn't be a thought in their mind to wanting to keep their group after you do it. So you want to kill it, unload on it, and make sure that they understand they need to have private coverage. So then the next 2 types of insurance that people can have could either be cash value or term. So I think today we're going to go through cash value first, and then we'll also go into some of the term slides. So what I sometimes explain, and everyone has their own little twist on how they present. This is how I present. If you guys have a way that your trainers or uplines have taught you how to present, you don't necessarily have to do this, but these are just some of the things that I do. So before I go into it, I just kind of explain a little bit of the differences. So all right, Mr. and Mrs. Client. So cash value, there's 2 major differences between cash value and term. So with cash value, it's usually a permanent policy. So what does that mean? As the insurance company, this is a policy that says that it's going to cover you for your whole life or most of your life. So that's why it's permanent. And it usually has 2 components. It has the protection, and then it also has the savings. So because you have 2 components, the protection, which is like your death benefit, if you pass away, that money goes to your family. But then it also has this savings portion within the policy that they say can grow, usually because it has those 2 components and it's covering you for your whole life. It's a little bit more expensive than term. So that's there. Then I say, okay, well, term on the other hand, term covers you for a period of time. And there could be different types. There can be an annual renewable term, which means it could go up every year. It could be a 5-year, which means the cost changes every 5 years, or it could be level for a certain period of time, 20, 30, 35 years. Now, the main difference here is term insurance is just pure protection. So just like your car insurance and your homeowner's insurance, Sheila, if nothing happens to your car or nothing happens to your home, do you get any money or anything?
No.
No, right? So with that, it works. Term insurance works exactly the same way. If we don't die, there's no money, there's no buildup. But because of that, we can get the highest amount of coverage for the lowest cost. So I just go over that general breakdown so people can kind of have an understanding. And sometimes the client may not know what they have at all. So I always want to go through both. Now, after I go through that explanation, then I say, okay, well, here's some information about cash value. So one of the major reasons why people want cash value is for that savings aspect. So let's look at an analogy here. Let's say you were going to open up a savings account at a bank. You just tell me which one you would prefer. And Sheila, these are super, super easy questions. Trust me, I'm not trying to trick you. So just tell me which one you would prefer. So if you put your money in the bank, would you prefer to have a higher rate of return or a lower rate of return?
Higher rate of return.
Exactly. And once your money's in the bank, would you prefer the money belong to you where it's liquid, you can take it out whenever you want, or it belonged to the bank where you got to borrow it, pay interest on it when you take your own money out?
Bank A.
Bank A. And if you pass away, do you want all of your money, all of your savings to go to your survivors, or the bank to just say, hey, well, we'll just keep it?
Definitely Bank A.
Bank A. So in that scenario, we would always pick Bank A. Is there anything that I could tell you to pick Bank B?
Nope.
No, never. Now, if you started off with Bank B, for example, and then found out about Bank A, how quickly would you make that change?
Immediately.
Immediately. So when we look at this scenario, right, now we just broke it down to them. They just told us that they would always want Bank A, never pick Bank B. Even if they started with Bank B, they would switch right away to Bank A. So then we break it down to them. I'm like, all right, well, unfortunately, Sheila, this is exactly how one of the cash value policies called whole life works. So let's say you have your death benefit, you have 150,000, you're usually paying a significant amount, usually 8 to 10 times more than term. And all of that extra premium is going into this cash value. And in that, unfortunately, the reason that the way that cash value works is exactly like Bank B. And then they're like, what? So when you look at it, yeah, so unfortunately it works like Bank B, and the money all going into that savings grows at a very low rate of return. The money actually doesn't even belong to us. It belongs to the insurance company. So if you want to take any of that money out, you got to pay interest. And if you, like, let's say, for example, you have 30,000 in this cash value over years and years and years of having the policy, and you take any of that money out, it's a loan. So if you pass away, that loan, if you took out 20 grand, that 20,000 is coming out, plus all of the interest that accrues on it. So you're not even getting, your family's not even getting the full death benefit because you wanted to use your own money. They're going to say, oh, well, now your family has to pay that loan back since you did it. And then the last thing, that the money actually, because the money belongs to the insurance company, if you pass away, they keep it. So if you don't take any money out of the savings and you die, the insurance company just keeps all 30,000. So my question, Sheila, is if somebody knew how this policy worked ahead of time, do you think that they would ever invest in this?
Absolutely not.
Never.
There's no way.
No way. So when we look at this, the key word here is knowingly, or know how this works. And most people don't know. And so that's why we like to do this analysis. So if somebody had whole life, right, then I would say, well, I mean, how much longer do you think you would want to keep this policy, Sheila?
Never.
Never. You wouldn't want this, right? So then at that point, I usually try to see if I can get any more details about their policy. Sometimes people literally get up and go grab it. They're like, oh, I got to check this. I got to confirm. And so what we're going to do now is there's a couple examples that Sheila had about a client. Actually, I think it's just one for whole life that we're going to go through really quickly. So Sheila, you can go ahead and just explain.
Okay. All right. Good morning, everyone. So like Chantel said, all I do is I really try to encourage people to look at their policies. Now, they're probably not going to understand it because these people that I've talked to, I mean, it's not like they're not dumb. They're just ignorant, meaning they just don't know. And then another thing is they're very, very trusting. This one, for example, is a friend of mine who you know, we've been friends for a long time, but, you know, I've been like kind of asking him, but I was never really that aggressive until actually this year was when I just didn't care anymore. I just kept texting people all the time. So this is an example where I kind of badgered him and said, look at your policy, because this was sold to him by his cousin, okay? Now, if you look at it, it says policy date was 2012, August 1st, that's when it started. He had been paying $100 every month, okay? And the death benefit, if you look at it, it says base plan death benefit is only $58,417. So this friend of mine has 5 children, okay? And I said, first of all, if you pass away, I said, do you realize that your family will only get $58,417 as of that date? And he goes, my God, I did not know that. And I said, exactly. And this is why I encourage people to read. And I said, do you think $58,000 is enough for your children to live on? Okay. And he goes, absolutely not. So I said, so number one, that is already wrong. Now I said, however, I said, granting, because you were overpaying your premium, which is $100 a month, which is crazy, and when he was only in his early 30s, okay? The cash value that accumulated was $4,459.60. So in this particular, they added the death benefit to the base, the cash value to the base benefit. And even at $61,817, I don't think that's a deal breaker with 5 children. I said, for them to put you 6 feet under, that in itself can be anywhere between $10,000 to $30,000, depending on how elaborate your funeral is, right? I said, do you think your family can live off $40,000 and for the rest of their lives? And he was like, you know, and he was like, absolutely not. And I said, I'm gonna ask you this. When your agent, which is your cousin, by the way, asked you about, you know, about your needs, I said, did she ask you about your needs? Did she break it down to you, or did she just ask you how much you could afford? And obviously he said, well, she asked me what my budget was. And I said, well, there you go. Because you told her that you can only afford $100. I said, she's probably thinking, okay, $100. She's already counting how much commission she's going to make. And she didn't really tell you what you really needed. Now, this is like 8 years now, okay? And he was like, it really was an eye-opener for him. And I said, first of all, let's break down your needs. So I went through the DIME formula. And if you're unaware, it's the, you know, DIME, which is D for death expenses, I for extra income, M is for mortgage and debt, and E is for education for the children. And another thing is his wife wasn't even insured. Okay, his wife had nothing but group insurance. So I said, just by that, basing on what you need, I said, you need at least, well, because he only has like 200,000 on his mortgage, right? I said, at least you'll need, I said, it's at least 300,000 to 500,000, right? And he goes, okay, so let's see how much, you know, how much it is with you. And I said, just so you know, the $58,000 of death benefit when you're in your early 30s, I said, I can't even give you a quote for that because it's too little, right? But if you hypothetically broke it down, I said, it would probably be maybe $9, $10 a month. And he goes, really? I said, yeah. I mean, that's being expensive already. And he goes, oh my gosh. And I said, yeah, I mean, this is crazy. So what happened with him was he realized that he was underinsured and he was overpaying for it. So now I was able to actually get him and his wife a coverage for $300,000 for him and $500,000 for his wife, because the wife actually makes more money. Okay. And they are now insured for $800,000 total, and they're paying $164 a month. Okay. So he's paying $64 a month extra for basically a death benefit of $740,000 more. Now, is that a no-brainer or what? Right. And I was so pissed. I'm like, go call your cousin. I said, just call. Because I get right to it. I'm like, these people, I said, I don't care if they're related to you, if they're people you think you can trust, people you work with, you know, people you go to church with. I said, all of that, when it comes to money, some people, it doesn't matter. They're looking at their bottom line, not yours, not your best interest. And it really does wake them up, because I'm like, get them on the phone, I'll talk to them. And they're like, oh no, we won't do that. They never do. So, so anyways, that's how I get all these clients, right? So this is one example, right? So now he's very thankful, and I guess we can move forward to the next example.
Yeah,
do you guys have any questions about this?
We'll do the questions at the end. So if you guys have questions,
Okay.
write them down and or put them in the chat, and then we'll go through the questions all at the end just to make sure we get through everything. But that was amazing, guys. And so
I always tell, oh sorry, Chandel. I always tell them this, okay? The numbers do not lie. I said, but people do.
yes.
Right? So, and that's like, oh yeah. You know?
There's a song, right? Women lie, men lie. I'm pretty sure. So awesome. So that is whole life, guys. That's whole life. Very, very low amount of coverage for very high costs. You guys saw that breakdown. So then the next thing in the quadrant, so after you go through whole life, there's a little button in the corner that says universal life, right? So if you hit universal life, then that will go into universal life. So universal life is different, guys. So you have to be very careful when you explain whole life and universal life, because there's different outcomes. In universal life, sometimes you can get the cash value. So, I mean, while I was growing in the business, there are times where I was like, oh no, you can't have cash value. You're never gonna get the cash value if you pass away. But in universal life, I learned that there were some cases that you can get the cash value. So we always want to make sure that we're explaining it properly. So with universal life, one significant difference is it is a lot cheaper than whole life. Then it's also called flexible premium adjustable life insurance. So with that, sometimes you're like, oh no, I don't have universal, I have this other thing. It's the exact same thing though. So anytime you see universal life or index universal life, so it sometimes has an index in front of it, flexible premium adjustable life insurance, it's the same thing, guys, same thing. So let's go through the example here. So I say, all right, Sheila, so this is kind of how universal life works. You have your money and your premiums, and it kind of goes through this pipe system, but we call it the leaky pipe. So before any of that money gets all the way to your cash value, money comes out along the way. And what does that money come out to take care of? The cost of insurance and then fees associated with the policy. So let's say, for example, you were paying $100 a month. Your $100 would go and some money would come out for the cost of insurance. So then you have $60 left. Then you would pay the fees, and then you have $46 left over. That $46 would go into the cash value. Great. But what they cleverly don't tell you is that every single year, the cost of insurance increases. So maybe about 8 to 10 years later, that cost of insurance doubles. And now instead of it being 80, instead of being 40, it's now 80. So you have 20 bucks left. You still pay the fees for the policy. So now not $46 is going into the cash value, only $6 is going in. But Sheila, do we stop aging after 10 years?
Absolutely not.
No, I wish. I wish. Right. So with that, we age again. Another 10 years goes by, the insurance gets more expensive, it doubles again. Now it's $160 for the cost of insurance. So now we're negative 60 because we're only sending in $100. Then we still have to pay the fees. And now the insurance company needs $74 more to keep the policy going. So Sheila, where do you think they're going to get that money from?
From the cash value.
Right. So they're going to start pulling money out of the cash value. And the unfortunate scenario is if this continues happening, that cash value can get to zero. Once it gets to zero, the entire policy can lapse and cancel. Now you have no insurance, no investment. If you learned that you own something like this, how would you feel?
I'd be pissed.
Right, exactly. And that's
really
what
pissed.
All the clients say that. I'll be pissed, I'd be mad, I'd be upset, this is a ripoff, how is this even legal? I've heard all of those things, right? So this simple image can explain the policy. And usually at this point, they're like, okay, I got to get it. Now, Sheila is going to actually go through some examples. And I think that this policy is a little bit more prevalent in what she's seen. And so she's very passionate about it. So we're going to go through some examples, take good notes, because these are the things that you're going to have to look for in universal life. Okay.
Okay. All right. So this is a friend of mine. Actually, I went to college with her. And I basically, like I said, I've been like just calling and texting or Facebook messaging everybody. And I was like, hey, do you have a policy, blah, blah, blah. And she goes, yeah. And then so I said, why don't you take a picture? I'll look at it. I said, I do this all the time for free. And I said, I really do care. And she's known me for so long that she knows how I am. Like, I'm very straightforward, and I really do care about, my family and my friends. So needless to hear, we're going to keep going. Anyways, so if you look at this, right, there's a minimum monthly premium of $61.64, and then a monthly guaranteed premium of $81.65. Okay, her plan premium is $121.42, meaning to say that's exactly how much they take out of her bank account. Okay, and if you look at the face amount, her death benefit is only $100,000. Now she has 3 children. Okay, and again, I said, first of all, that 100,000 is not enough. You always have to point that out, because you always ask them, if something were to happen to you today, I said, will that 100,000 last long enough until your kids get on their feet and your husband's going to be okay? And she goes, no, absolutely not. Okay. So once they see that, they immediately think that, okay, that really sucks. Right. Then I said, for the $121.42 for your age, I said, and $100,000 of death benefit, I said, you're overpaying clearly. Okay. And if you look here, it says death benefit option B. All right. If you look at that, that's actually, it could be termed as option 1. There's option A or option 1, option B, option 2. So when Shondell was talking to you about the cash value, wherein the money, whatever cash value goes that you have actually will go into the policy, that means it's option